Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. Today I'm going to go through Twitter, see what people are sharing on social media. I'll interject my financial opinions as we go through it together, generally related to three different topics: wealth building, commodities, and/or financial topics. Let's dive right in, take a look, see what's going on today. If you want to follow me, it's at Finance, and if you want to join our community, finding-value.com, where I dive deeper into all these topics, subject sectors, looking for investment opportunities and sharing those opportunities with everyone in the community. We do have a special going on. Special is the coupon code. It is $25 for the first month on a monthly membership, and it's $100 off, which makes it $500 a year for a yearly membership if you'd like to sign up, either directly to the yearly or swap from a monthly to a yearly. All right, so we got Evan here. President Trump just said, "Don't worry about China. It will be fine." Z doesn't want depression for his country, and neither do I. Says, "Don't worry about China. It will be fine." Highly respected President Z just had a bad moment. He doesn't want depression for his country, and neither do I. The USA wants to help China, not hurt it. President DJT. This is why they don't want people. This is why we shouldn't allow a president to do what he's doing, which is turn off tariffs, turn off. That's why we usually have to vote on it through Congress. Um, is there insider trading going on here? My guess would be a highly likely scenario, as we'll get down into some of this of what some people are doing in crypto and other things. So, what's going to happen Monday? When you guys are listening to this, I don't know. I don't know what's going on. It seems like every other tweet is in opposite directions. Like this guy, we got to calm this down. We probably shouldn't be tweeting any of this stuff. Probably shouldn't be putting 100% tariffs on gigantic countries on a whim. That group of people doing this. But I don't know. We'll see. We'll see what happens. And all I'll say is that I'm sure there's going to be a whole bunch of volatility coming, and be ready for it. Be ready for it. Saudi Arabia crude production declined by 551,000 barrels per day in July. Exports went down by 147,000 barrels a day. What's going on here? I thought we were going to be pumping up exports and production. Why is crude oil production declining? What is going on? Now, here's my theory. I think the news is releasing stuff that Saudi Arabia probably doesn't even know. Could it all just be fake news? I don't know. It could be. Usually in the summer, you know why they bump this up? They bump that up because they run electricity. Their power generation is from oil. So in the summer, when it's really hot there, they bump up production to produce electricity for air conditioning and cooling all their, basically for increased electricity demand in the summer, put it that way. Now, the exports over here, look at crude oil exports. Do you see any more exports here? You see what's going on. The news is telling us that likely, and rumors say, sources tell us that production quotas are going to go up. Where's the oil? Where's the exports? I just find it interesting. That's all. I find it very interesting. I feel like I'm being lied to, guys. I feel like that's kind of the likely conclusion that I'm running into here. Mike Simonson says, after a very slow start to the year, we're finally showing cumulative year-to-date pending home sales up versus 2024. They're now up 74 basis points. That is inching higher each week. So we've seen a drop in mortgage rates. Here's the decline in home sales in the beginning of the year. We had a bump up in April, May, kind of came back down, and we're ending a little bit stronger here as rates have declined over the summer there. So we'll continue to watch this, see what home sales do. If they continue up, that's not recessionary necessarily. The residential real estate market is a major cornerstone to the economy. A lot of jobs, a lot of things go through that area. Now, we did see some construction spending kind of rolling over a little bit. So, how this all pans out here over the next, say, year or two, tough to say. Tough to say. I do think that there's home buyers out there if interest rates go down, which makes me think that there's people coming out saying that we're going to enter some 1929 crash. I don't know if they know a lick of history. That crash was created by defaults in the residential real estate market, like massive defaults. And then the banks ate it all. That's deflationary, massively deflationary. If we were to lower interest rates to like 2.5%, 2%, I mean, like really, really lower them, I would bet that you would see home sales go up leaps and bounds. You would see a gigantic move higher. That is not what a depression or deflation looks like. Deflation comes from a deleveraging event. A deleveraging event occurs when you have bad loans, a lot of bad loans. And usually that comes from residential real estate. That occurred in 05, 06, 07, 08. All that stuff had bad loans. Same with 1920s and into the 30s. It was all bad loans and they were all going bust. I don't think we have anything even near that. I mean, that's like, you might as well just come out and say, oh, no, this is just like the 1929 crash. That's like saying, I don't know anything about history and I don't know anything about markets and I don't know anything about what drives markets. That's kind of what I'm hearing. It's like, okay, if the drivers of the big crashes are all residential real estate going bust with a whole bunch of bad loans, do we have bad loans in the system in residential real estate? No, we don't. Okay, so how are we going to have this bust? I don't know. Because the majority of homes have massive equity built up into them. The government it needs higher tax revenues. They're going to be more likely to hyperinflate the currency than to go into a deflation. So where is the pressure going to come from? It's not going to come from fiscal cutting, I don't think. It's not coming from bank deleveraging loans. Could there be other problems? There could be. You know what they're going to do? I can tell you what they're going to do if there's a problem in the banking system. They're going to give everybody stimulus checks and bail out the banks secretly with stimulus checks. So everyone's like, oh, I got an awesome stimulus. It's sitting in their bank account, which just bailed out the banks. If they were to do that, that would be my guess. Kind of like what they did in 2020. Howard Marks says the relationship between price and value holds the ultimate key to investment success. Buying below value is the most dependable route to profit. Do you know why that is? Why is that? Why is it so easy to make, or why is it the most dependable way? It's not easy. The most dependable way to make a profit. I will tell you how. If you always avoid overvalued products, that means you never buy market tops. Market tops are always overpriced. Always. Market bottoms are always underpriced. So what this does is it always forces you into the undervalued, underpriced areas, which keeps you at the bottom of the cycle. If you avoid everything that is overvalued and overpriced, that means you never go in at market tops. So the way to handle risk is to not overpay for crap. Always buy it cheap. And then someone will say, well, yeah, but that means that I have to wait for the price to go up eventually. And my answer is yes, that is correct. Sometimes when you buy something that's very underpriced, it takes time for it to go up. Then people will make up excuses. Well, I don't have time. I don't. I can't wait a year or two. Well, then fine, lose your money. I don't care. It's like you can't have it both ways. You need to adapt to what the market is going to give you. You can't force it. This isn't MySpace or an app where you swipe left and swipe right. It doesn't work like that. And there's better strategies and worse strategies. Just like when you go work out, there's better routines, and then maybe changing your routine on a certain frequency is better for gaining strength than other strategies and routines. And just because you choose a crappy routine or a crappy strategy doesn't mean you should get overpowering results of a different strategy that might work far better. But that strategy that you're going to adopt that's far better might require you to change your time frame. You may have to change and adapt to the market versus you trying to force your wants and needs onto the market, because it will punish you. And it will punish you, it will drive you into the dirt, and it will take all your money. And I'll show you what, later on, that happening to people. It says if BTC USD were to break higher and maintain its bull, gold and silver investors would be wise to remember Friday's valuable lesson. You can lose it all in a bull market by being stupid. Don't trade it, don't leverage it, don't make all-in bets. Still think this pattern fails to the downside. And that's Bitcoin priced in dollars. Now, if the dollar's falling rapidly and this were to fall in dollars down, holy underperformance would that be? I mean, if this gets cut in half or 90% or maybe even 95% lower, and the dollar drops 75% with it, do you know how bad that would be? Coming down, Gary Baum says the rally in gold and silver is not a celebration of prosperity, but a subtle referendum on trust. When real assets rise against paper ones, it is rarely a sign of exuberance. It is an expression of doubt. What markets are really repricing is not gold itself, but belief in the competence of governments, the independence of central banks, and the idea that the promises embedded in our financial system can stretch indefinitely without consequence. I wouldn't go that far. What I would say is it's all part of a cycle. And when things get overpriced in one area, like paper assets and bonds, and other areas get underpriced, like gold and hard assets and commodities and emerging markets, the cycle will eventually turn at some point. So it's not it's disbelief in government per se. It's all part of a cycle. And yes, I mean, you can put a narrative to disbelief, but if you're a part of the cycle, if you get into the cycle where they have to print a bunch of money and inflate their way out of the debt because that's where we're at in the cycle, and then you could say, well, it's because of the disbelief in paper currencies. It's like, well, yes and no. You're if every part of the currency cycle ends in disbelief, it's all part of the cycle. It is all part of the cycle that you're going. And then if money was all jammed into financial assets and hard assets are undervalued, then the money's going to rotate back at some point. It won't stay like that forever. Because we've seen the cycle occur in every single currency in the history of mankind. They all go to zero. So why would you store it in any sort of currency or bond market? I wouldn't. But there are times in history where they outperform or they do well in, like a declining interest rate environment. But I think that's behind us. T.O. Birkin says Warren Buffett underperformed all bubble periods, was written off every time, and yet in the end outperformed almost everyone in the very long run. He missed the following. He underperformed the Nifty 50 bubble in the early 1970s. He actually sat out the whole thing all the way to the peak. He underperformed the dot-com bubble in the late 90s, and many people wrote him off, claiming he lost his touch. He didn't own a single internet or tech name. People laughed and ridiculed him for years. He underperformed the commodities bubble in the early 2000s. He didn't own any miners, any commodities, including gold, and had virtually no exposure to emerging markets by their peak, late 2007. That's not a true statement. Because I watched the 2000s. He had a whole bunch of money in PetroChina, Chevron. He played the energy bull market perfectly. I think that is a false claim for number three. He's now underperforming the AI bubble too, even though he recently retired. The Chat GPT moment occurred during the 2022 bear market, and Buffett has not bothered to purchase even one AI stock since. I haven't purchased a single AI stock myself. Buffett never felt the emotion or FOMO, or never thought that his opportunity cost his crowd's insanity, bidding up stock prices. And yes, despite underperforming during every single bubble period, he achieved an incredible compounded annual growth rate track record that almost no one can match and might never match it in the future. You don't need to catch everything. We are not playing Pokemon. This is intelligent investing, and you should only strike at fat pitches and no-brainers. Avoid everything else. And remove emotional decision making, formerly known as affect heuristic, including envy. It really doesn't matter if your neighbor is getting richer faster than you are with AI hype. Again, it's all about managing risk. It's all about managing risk. Things in technology, they obsolete very quickly. So when you get into the AI game, I don't even know if those companies will exist if AI is successful. Let's say AI is massively successful. Would those large companies still exist? I am not even exactly sure. I mean, wouldn't AI kind of create AI at some point? And couldn't people open up companies even faster and better than maybe the existing companies? Maybe, I don't know. Wouldn't really bright and smart people become infinitely powerful if they basically integrate into, I'll call it a futuristic database that can allow them to access information eons faster? Could be, I don't know. We've got commodities here. I've been positioning these last weeks in stocks holding large metal assets. And here's Josh Young. He says, I believe a big is coming in commodities. And if, when it comes, we will look back on this chart and see that gold was shouting and screaming at us to take notice. I totally agree. Totally agree. Gold front runs it like it did here. Now, here's a weird thing. Look at back here. This is equated commodities rolled up before gold did there. Like gold did here. Gold ran up. There's the move that ran up. Then we went sideways. We went sideways in gold, and we went sideways in commodities. And commodities are just going to follow what gold's doing. It is my guess. And that includes oil and copper and uranium. They're all in it. So when someone says, oh, I could see silver going up, like, dude, silver goes up the same as oil does. That's like saying I've never looked at the two charts, and this time it's going to be different. We're only going to get gold going up massively, but never in history have we seen that before. We've never had commodities not go up with gold, ever. Even in the 1930s, when they repriced gold, what happened to commodities? Commodities all went up with gold. They all got repriced. So you're telling me that this time, oh well, it's hyper stagflation. We're gonna go up in gold, but commodities won't follow. They're gonna print a bunch of money, and that money is all gonna flow just into precious metals. Are you sure about that? What about people who want to do something in life? Like, what if they want to buy something with this extra cash? Like if someone got a whole bunch more money, let's just say a whole bunch of us did. Do you think they're not going to buy something at some point, like a house or cars or whatever? Find that very difficult. And remember, commodities and oil and all of these things are the feedstock to wealth. Gold is not wealth. Gold is a preservation of purchasing power, which people consider to be wealth. But gold is a final payment on an execution of something that somebody wants and desires or needs. So if I need to eat, I could spend gold to get it. But the final payment was the meat or the food or whatever it is. It's not the temporary holding of gold. They should have become gold and silver maximalists, although ZEC USD. So look at this. Look at this Friday move. A lot of people became Bitcoin maximalists yesterday. Look at the moves on these things. Now, I don't follow this that much, but someone who gets a 58% haircut in like 10 minutes, holy crap. 65%, 82% in a single day, which occurred on the back half of the day. I mean, this is like wipeout move. Morgan Stanley recommends 20% gold allocation. Meanwhile, 39% of fund managers have zero gold. We are early. There's 39% that don't have any gold, and this is 4%, 2%, and 6%, and then 8% or more, only 6% have that. All of the money, a lot of the money gets made when no one is looking. So when I was buying this is what I don't understand, okay? When I was getting into it, 2018, 2019, 2020, like that's when I was really starting to pump money into physical metals. I just looked at the ratios and I said, God, this is cheap. Then I looked at the cost curves. Silver was basically underneath the higher cost producers. Platinum was underneath it. And I'm like, well, tell me where the risk is. There's no risk in holding a physical metal. There is no counterparty risk. There's no jurisdictional risk. There's no management risk. There's no debt risk. There's nothing. So you're taking the least risk asset, buying it at the best possible time underneath the cost curve, while the ratios are dirt cheap against financial assets. Then you have the interest rates bottoming in 2020 and about to turn. I was banking on that turning at some point in the future, but I didn't know the exact timing of it. I just knew that we were at an incredibly good opportunity to buy silver and platinum and even gold during some of that time. I just knew that, and it was underneath the cost curve. I was like, this is a no-brainer. But you know what people are going to tell you? They're going to say, oh, well, what's the 10-year average return on it? How come it's gone down since 2011? It's like, what are we playing like short bus games here? Like, do you not see we're underneath the cost curve? Do you not see that we're cheap? So what's keeping people from making money is I think they think like linearly. Linearly means like if something's going up, it's just going to continue to do that for the rest of eternity. But markets move in cycles. Maybe they don't understand that things move in cycles and that you want to buy at bottom of cycle, and at a bottom of a cycle, you need to know that the traits and characteristics to look for, whether it be technical analysis, whether it be cost curves, whether it be ratios to look at. It's all of those things. Repeat, Cold War for commodities. The only way to expedite years of inadequate domestic supply chains is to throw money at it. And U.S. mining investors are already perfectly positioned. Buckle up. And this is the Pentagon has launched a $1 billion buying spree to stockpile critical metals aimed at securing supply chains amid growing geopolitical tensions. And now all of a sudden, you know where they're running? They're not running and putting their money into oil. They're putting it into lithium, rare earth metals, and stuff like that. Why are they putting it in that? Here's my guess. Because we're about to hit peak oil, and they know it. They know it. So they're putting in plan B, like we need to ramp up immediately because we're going to have problems in oil. That's my guess. Now, a problem in oil is also going to break our currency. And I think that's why we're seeing gold run up as much as we are. Now, I know that's really difficult for people to understand when oil isn't a problem this second. It's very difficult for them to understand. We're playing chess here, and they're used to playing beginning checkers with like 5-year-old kids. This is way past that, blowing way past that. So we're looking 5 years out, 10 years out, and positioning. And it could happen at any point from this point forward into, like, say, 5 years. Not checkers. That game's behind us. That's short bus, moves. Gasoline futures are trading at the lowest level since 2021. He's got this chart here. I was looking at it, I was like, really, gasoline futures are like this. And he cut it off at 2021-ish. Okay, let's go look here. Let's pull up I think it's, what is it? Gasoline futures are RB1. That's what it is. This is RB1. This is what he was showing. And what he did is he cut it off. He cut it off here. This is what I see. It's completely opposite of what he has here. So in my opinion, he is wrong. Gasoline, he put a little guy like this, and they always think it's going to break lower. They say shoulder, head with another shoulder on the right hand side. That's what most people will say. That is a wrong stance there, in my opinion. Let's get into it. So this is gasoline futures, which for the most part, if I were to put crude oil on top of it, it's just a crude oil chart. That's all it is. So gasoline is crude oil. Okay, so there's a gasoline chart. We have a 3-hump consolidation, 1-hump, 2-hump, 3-hump, and a false breakdown. We also had that here, 1-hump, 2-hump, 3-hump. We had a move higher that broke out of the consolidation zone, and then we had a retest. We have the same thing. We have a break out of the consolidation zone, and this here is going to be your retest wherever it ends up going. That's what it is, in my opinion. Now, why do I have confidence in what I'm describing to you right here? Consolidation. I can tell you why I have confidence. Because copper is breaking higher. Because steel is breaking higher. Because uranium is breaking higher. This phase that we are in right now is called the disbelief phase. You break out of a consolidation or a base, like this is your base or consolidation. This is your base or consolidation. Then you go and we break out, and people are like, oh, maybe this is going to go big. So you'll get a lot of big numbers going up here. People calling for 150 and more oil. But what they do is they lose conviction. They need to stay bullish the entire time, because this is a new paradigm where we're going to rip. It's going to do this. That's what comes next. A disbelief phase is when you break out of the previous consolidation, you break out, and then it goes sideways and people start to doubt it. This here is a disbelief phase move. This is wave 1, this will be wave 2, and we'll go into wave 3 soon. Why? Commodities are cheap to equities. Emerging markets are starting to outperform. We're seeing CAD USD, AUD USD. We're playing chess here, guys. You need to add up the information to come to a conclusion. You can't look at one chart. Oops, wrong one there. You can't look at one thing and be like, oh, well, I think it's this, and not take into all of the other things into consideration. Now, a lot of people also said on URA. URA has a very similar setup. This is your base. You break out of the base. This is your disbelief phase all through here. People started doubting the bull market. Well, we're not going to go into a bull market. Uranium's, it's done. I can't believe how bad. People chased into this up here, wrote it down, sold all through here when we were buying it on the website here. Boom, 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 load up, boom, retest, gone. That's your slingshot move right there. This is wave 1, this is wave 2, and we are ripping. And we can see these patterns across commodities everywhere. It's not just here. Now, do you think this is bullish or bearish? If this is your base and you've broken out of your base, is that bullish or bearish? It's bullish. And everyone here is complaining, oh, well, uranium's not going to go up. What is that? Is that not worth waiting for? If you bought in the base, here's one of the best companies that you could have purchased in this thing. There's your double bottom. You bought down here, you're a millionaire now with like 10,000 bucks. All you had to do was buy it and sit and wait. Look at the volume coming to this thing. My Lord. Here's another one. I'll just, here's Dennis and Mines. You guys see something here? Let me do it for you. What's that? What's this? Whoa, 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 whoa. What are we doing here? Shoulder, head, shoulder, breakout, volume. You guys see that? I'm just stating it. Now, I'm not stating that this is an undervalued stock, but it's got a hell of a pattern, and I'm seeing this pattern all over the place. This is a bullish pattern, not bearish. So if we've got all of these patterns that I just showed you in URA and some of these other ones, this doesn't move up by itself. It moves up when commodities go higher. This, here, let's put URA over COPX. Do you guys notice anything? It moves in the same direction at the same thing. Now this is wave one, wave two. Now tell me this. Do you honestly think with copper going up and steel going up and uranium going up, you honestly think that oil is not going to follow? I mean, do you really honestly think that? Do you think that gold, which is the leader, is going up and that nothing else will follow this? You really don't think that copper has a bottoming pattern here? I mean, look at, you can even overlay, they're pretty close, and copper is now starting to follow the equities. Really don't think that oil's not going to, it's just going to sit there and do nothing. Even though every single time in history, we've never had that disconnect. Okay? Okay. Silver versus Dow Jones. Historical chart shows a nice bull channel with three big consolidations. I like the big picture view. I don't like the short-term stuff. Roaring 20 saw silver lose 90% Dow Jones Industrial Average. But stagflationary 70 saw silver outperform Dow Jones by 3,750%. And that was an increasing interest rate environment, which we are in today. Given our starting point in this channel, we might see even a more outperformance this time. Look at where we're squeezing up into this corner here. It's a 45-year bull triangle. We had a 43-year bullish wedge here. Do you know what the difference was in these? This was a declining interest rate environment. Interest rates started to go up right around this area here, right there. It bottomed, turned higher, and ripped. And this is the ratio, keep in mind. Silver started going up here in the 40s, but Dow Jones continued to outperform silver. So this is a ratio. But then we had a massive outperformance as interest rates went above a certain level. And we're going to get above that level, and this is going to rip again, in my estimation. JC Parrott says, I spoke at a conference this week with 800 people in the audience. I asked them to raise their hand if they think we're in a bubble. Nearly the entire room did. The funny part, I never even said which asset. Interesting. Imagine your new retail sitting on the sidelines considering investing in crypto. Then you witness a market crash where multiple coins in the top 10 collapsed by 50% or more in minutes. You witness mass liquidations with billions upon billions of wealth being evaporated in an instant. You read reports of a massive whale who shorted the market the moment before the crash happens. Do you still invest? No. You're just buying garbage, guys. No, you do not invest, in my opinion. I don't know what the heck any of these things are worth. They should be zero. What are you buying? What do you own? What is it a representation of? I mean, Fartcoin? I mean, really? That's what you're going to buy? I don't know. Objectively, the entire crypto market now appears to be entering a bear market versus silver. You want to be in silver. See, this is the toughest part. And it's so deep in society and in the herd. The herd can't shake it. They are incapable of having independent thought against everyone else. And this is the problem. Everyone just wants to fit in. They want to fit in the herd. So what do? They go pile into crypto because it's going up. They use price movements as a justification for buying something. They have no idea what they own. They have no idea what this stuff is. Everyone just is chasing price. They know the price of everything and the value of nothing. And right now, you know what usually happens at the beginning of bear markets? You get a major sell-off. It usually happens at the beginning of the bear market, and that's what like kind of pushes this whole thing over the cliff. Silver, a chart pattern that has taken 5 decades to form. It's not the type of action that gets derailed by fake mainstream headlines, government misdirection, or a short-term emotional retail traders. This is a generational setup that is now unfolding. Go long and stay long is the key. I totally agree with it. Go long, stay long. I bought right here in this handle here. That's where I was really getting in. Now, some people will say, well, that doesn't help me. If I told you what was great, oil is great right now. Do you know why? Because no one gives a crap. No one cares. Now most people that are listening, they're gonna say, well, I don't want to buy oil. It's not going up. That's my whole point. You're playing checkers, guys. Like that is checker mentality. Chess is where you anticipate moves. Checkers, you're just reading it and you're playing a very simple game, and it's like go, and you just kind of go through the motions. You got to think 5, 6, 10, 20 moves ahead. You've got misdirection all around you. You've got news, which is fake news, in my opinion. You've got crap that isn't correct. And it's to misguide you everywhere. If you can't use the news for positioning, what do? You use long-term thinking, you use positioning, you use the fundamentals of the sector out in the future. And whether that comes true or not, you're going to have to make some sort of you're going to have to draw to some conclusion to make an investment decision. And you can't sit there and just think and think and think. Like you got to say, okay, this is the setup. What's my risk? What's my reward? If there isn't much downside risk, well, that's taken care of. The upside looks pretty good. I'm going in. And it's that simple. Now, if people are looking, well, what's the 10-year price performance return on this? It's like, dude, you have no idea what you're doing. I mean, that's like what I would do when I just first started investing. Like I would look at like the performance of ETFs and then try to like go after the best performing ones. That's not how you make the most amount of money. You make the most amount of money by discovering that there are cycles in the market and that you want to buy at the bottom of every cycle. And at the bottom of every cycle, that's almost when the majority of things are underpriced. That doesn't mean that they're underpriced on a free cash flow basis. It means that they're underpriced on, let's say, like a price to book ratio or something where you're pricing the value of the company and the assets, and then you compare it to the price that you're paying. That is how you make the money. It's not made by chasing price performance. Because that's what you're saying. Well, in the past 10 years, you're chasing price performance. That's really what it is. And that is like really, really bad to do. Not how you make money. How you lose money. Tavi says conventional wisdom tends to view a strengthening dollar as a sign that investors are seeking liquidity in moments of stress. The narrative, that narrative has some truth to it, but history shows a far more structural relationship at play. Over the long run, dollar cycles have consistently mirrored the relative performance of U.S. assets compared to the rest of the world. When the dollar rises, U.S. assets dominate. When it falls, global and emerging market assets tend to outperform. And I would say that backwards. I would say that when U.S. assets dominate, the U.S. dollar rises. They're interconnected. It's all part of the cycle. It says, keep in mind, you don't fix persistent twin deficits and overvaluation with the rising dollar. It's quite the opposite. A weaker dollar increasingly looks like the implicit and perhaps inevitable policy choice the U.S. will need to make to stabilize its financial position and avoid a broader economic dislocation. Seen through that lens, the potential depreciation of the dollar could act as the catalyst for a much broader reconfiguration of global capital flows. Getting warmer here. As the dollar weakens, the gravitational pull of capital begins to shift. assets and businesses outside the United States, many of which have been neglected and remain deeply undervalued. Undervalued, bottom of cycle. Could see a meaningful re-rating as investors search for value in a new geographies, in his opinion. Dollar index going down. We saw the U.S. price return index, MSCI emerging markets, the ratio go up and down with the dollar. And when this is going to go down, whenever that breaks, I don't know when, we'll probably see the emerging markets outperform. And emerging markets are well set up and positioned for that outperformance. We basically have a squeeze up here that we've broken to the upside of. So I think it looks really good for that. It's gonna unload to the upside. It's gonna move. Looks fantastic, actually. He says, imagine putting your entire net worth on a public address where everyone can see exactly what you own and what you buy, where the government can track you 24/7. Yes, this is apparently the future of money. Crypto's great, yes. The most important question is, if we all lost money and 19 billion got liquidated from the crypto market, then who the heck made the money? Yep, that is a good question. Eric Trump coming out. He says Q4 will be unbelievable for crypto. No insider trading there, though. It'll be unbelievable. He just knows it, all right? He just knows it. Trump is making insider trading great again. 30 minutes before President Trump's tariff announcement, a whale took a multi-million-dollar short in Bitcoin. I'm sure it was just by happenstance. I'm sure. Sure. Kind of like people shorting the airline companies right before 9/11, just by happenstance. And the volume spiked right before it. That's what's weird. That's all I've got for today. So we're going to end it there. Give me a thumb up for the content, guys. Subscribe to the channel. Subscribe to the website if you'd like, especially with the coupon code. And that's all I've got. So we'll catch you next time, guys. See ya.